Yeah, so there's those three very small recent statistics that said, oh, well, maybe something positive is happening. And of course, it was just those little glimmers of good news were enough to spark the stock market rally that we saw on Monday and Tuesday. It's pretty difficult to assess if this is just a head feint because we had this in July where we had a big rally that went nowhere, or is this the beginnings of a true recovery? But putting aside the stock market, certainly if one looks at the actual statistics and what companies themselves are saying, there really has been no measurable progress on bringing inflation down. So I'd also just think like right now, like maybe two good questions to ask at this point is how realistic is that 2% target, for the intermediate to longer term? And well, what's required to get there? So if we talked about before, I know for sure in the last call, the economy now of 2022 is really facing numerous inflationary pressures that it's going to make a 2% target more difficult than, in our opinion, is being anticipated. And just to run through them again, these various inflationary pressures, because honestly, each one of these would be an interesting call just in itself. But kind of in order, at least that I have in my mind, rising rents, which are tied to housing inflation, that's the biggest component of the consumer price index, about 40%. So the runaway housing inflation over the past few years, well, I guess since the pandemic, definitely has pushed up rents, and that's pretty difficult to slow down. So that's one. Another item that just seems to be a permanent presence for all of us is healthcare inflation. It's hard to see that moderating just on its own. Some kind of newer ones that have popped up, the energy transition that, again, it seems like it has to happen. It will happen. It's very expensive. Another inflationary pressure, just what's happening with labor, particularly not enough of it. Big drop off in immigration, long COVID, even ongoing COVID, and just the natural aging and people retiring that occurs in a wealthy society such as ours. And also there's just wage pressure just because when prices are rising, employees are more empowered to press their wages higher. And that's the infamous spiral that can occur. A long way from that, but it's certainly, we're closer to it than we have been for a long, long time. More good news from the inflationary front. The fiscal stimulus, the spending the federal government does, seemed like maybe that was slowing down. And then we just announced this big student loan forgiveness, another $500 billion over a decade. More money out there, more money to be spent. And finally, the last one, I don't know how to quantify this, but it's really just something that's occurred or it's been accelerating recently. It's just this economic nationalism, I call it, where free trade is not really being espoused by anyone. And we have lots of countries bringing home their manufacturing or bringing home this, bringing home that. Maybe an easy example for us to see is the big government push here in the United States to make us a semiconductor manufacturing powerhouse. And many other countries are doing that, doing the same thing. Again, we could talk about this for hours, but and each country has their own reasons, and it's I'm not here to assess whether that's good or not from a geopolitical standpoint, but just from an inflationary standpoint, it's wasteful, and it can cause inflation because many of these goods can be produced less expensively somewhere else, and to try to bring everything back to your home country can make things more expensive than they otherwise would have been. That seems like it's the trends in that area from an economic inflationary standpoint are poor. So with all those things going on, again, just ask, well, how realistic how are we going to get inflation down to 2%? And I guess really in our opinion, it's not very realistic unless some of those trends are reversed so severely to really reduce the overall rate of inflation. And for better or worse, the only ones really susceptible to Federal Reserve policy are the housing prices and employment. So, and I realize this isn't a popular or cheery thought, to bring down inflation, unemployment has to rise and home prices will have to decline, and probably more significantly than is being assumed. And this is really the quandary that the government is facing, the Federal Reserve part of the government. Should they continue to tighten policy until the housing market really goes into recession, causing wage pressures to dissipate, and until inflation is brought completely to heel? Or maybe just decide a higher rate is acceptable, a higher rate of inflation is acceptable, and let's just move on. And that's actually what I believe is going to happen in the end. At some point, maybe even by the end of this year, but certainly in early 2023, there's going to be some progress against inflation. The gasoline has decreased. Many other things have kind of calmed down a little bit. There's going to be some progress that'll show up in the numbers. And the Federal Reserve will say, okay, we don't need to keep tightening anymore, even though the inflation rate isn't 2% yet. And that decision should reverberate around the world. And really, we're just going to see where inflation settles out. I know it's kind of, I'm not trying to be casual about it, but that's just really what's going to happen. It might end up at 3%, it might be 4%, it might even be 2%. We'll just have to wait and see how it plays out. But I don't think that they're going to wait until it hits 2% and then take a deep breath and say everything is okay now. I just wanted to elaborate a little bit on that reverberate around the world phrase, because what we've really witnessed when the US tightens their policy, most nations really don't have any choice, but they have to tighten their own policy too. They have to raise their interest rates or else their currencies fall apart. And most nations have indeed followed suit, imitated what the Federal Reserve is doing. That still hasn't prevented their currencies from going down. It's great for us as tourists, especially to the UK, maybe some other places. But it does hurt, as Americans, it hurts our international investment. And what's saddest from the international perspective, from their perspective, is that their inflation isn't the same as ours. Because our inflation is caused by overstimulation of the economy from the pandemic recovery efforts. Most nations' inflation is more due to rising energy and food costs. And thus, for them to tighten policy doesn't really make economic sense, except to defend their currency. So that's really a difficult situation that they're facing. But let me at this point just kind of summarize, the thoughts so far, and obviously want to hear what's on your mind. But my summarization of it is that the progress against inflation has remained difficult to locate, and thus we can and do expect continued tightening financial conditions and higher short-term interest rates. And the progress will come when the economy slows enough to bring down housing prices and alleviate some of the wage pressure. Another prediction of continuing with this, inflation will stabilize at a level above the 2% target and we'll all cope. There's nothing sacrosanct about a 2% level. For investors, stability is paramount, and we can realistically look forward to that, this version of stability as we hopefully put the chaos of the past 2 years behind us, we hope. And I really just have to emphasize one thing here, that really the caution still needs to be the watchword for now, because really this insistence on the 2% target, it's just by necessity going to force a deep and painful recession and would not qualify under anyone's definition of a soft landing. So with that kind of just sobering thought, I guess I'd love to hear what's on your mind, and Kate will go through how to participate and unmute ourselves and all that.
All right, thanks, Nate. So if anybody would like to offer a question and chat with Nate, if you are logged in on your computer in the lower left-hand corner, you can mute yourself. If you are on the phone, if you hit *6, That's an option. And again, if you prefer to put your question in the chat box, that I will read them out, and that's also an option. So with that, feel free to
Mhm.
ask questions. Oh, got a question in the chat box. Hold on just a second. Why have bonds gone down too?
Okay, well, basically, 98% of bonds just have uh, the price is inversely related to interest rates. In other words, when interest rates go up, bonds go down. What makes interest rates go up? Well, you could say it's government policy, but it's really inflation. So inflation is we've seen it can be bad for stocks, but it's guaranteed to be bad for bonds. It just means that the purchasing power that you get from the interest that bonds pay, it goes down because, oh, that $50 that we receive from our bond buys less than it used to. So the price adjusts so that that 50, when new people are buying bonds, that they don't get $50, they get $60 to buy the same amount of food and gas. And that's, in other words, the price has to drop to increase the yield from the bond to make it make sense when things cost more.
Hey, Kate and Nate, thank you for hosting this call. This is Val. Nate, I walked into this conversation actually expecting a little bit more of a doomsday, conversation, and it sounds like you're optimistic that the economy will eventually work itself out and inflation will go down. I am personally preparing for the worst and for this to just be the beginning of it. And so, is that an accurate read? Should we be prepared for a recession and buckle up and this is just the beginning? It's going to get worse before it gets better?
Well, it's kind of interesting when people say about, are we going to have a recession? Because actually what used to be considered the conventional measure of recession, which is 2/4 of the GNP going down, that kind of already happened the first half of the year. I guess honestly, it's anybody's guess how much unemployment, which is to me, that's my definition of a recession, when there's widespread unemployment and really people can't find work. That is not the case now, of course, even though, again, if you looked at those top line, very simplistic way of measuring a recession, some economists might say, oh, we're in one now because look, we're down for 6 months. But I'm sorry, not when there's 11 million unfilled jobs. And very broadly speaking, anyone that wants to find a job can find one. And most industries, building, you name it, can't find people, hospitality, can't find people to work. So we have a really long runway before we're actually in, what a recession that, that would really, really affect the overall economy. So I'm not sure that's going to happen, to be honest, because there's a very long way to go. And there are many trends. I mentioned some of the negative aspects of the inflation and all of that, but there's still lots of positive things going on that should make us all optimistic about the long-term future. I'm not going to talk about the next 3 months because nobody knows about that. But long-term, the kind of technological advances that are happening, and you name the field, biotechnology, artificial intelligence, robotics, so on down the line, the efficiency that so many companies operate with now, the enhanced stability that the financial sector has now as a result of the regulations that were put in after the 2008 disaster. Those regulations that were pilloried so much then by Wall Street. Now, of course, they love them because the banks all have these great capital cushions, and the stock market's down by 30%. And the American banks are just fine. They're seem to be, but based on every possible way of looking at it, very healthy. So, the underlying strength of the economy is fine. And if it turns out that we live with an inflation of 3 or 4%, but it's under control, that's, to me, that's fine. There's no reason to panic or to really be unduly concerned about what might happen in the next few months. If we really thought that we were about to fall off the cliff economically, we should all rush into long-term treasury bonds, yielding 3.5 or 4%. That doesn't seem like a very good long-term investment. And, we'd also just be losing out on the opportunity to stay invested in the great companies that really are continuing to do well. They did well before the pandemic. They did pretty well through the pandemic, and coming out of it, they continue to do pretty well. That's not to say that there aren't areas that are really going to suffer from rising interest rates. They've already done that. I know people are sick of hearing me just use this as an example, but the Bitcoins of the world, the meme stocks, they've all been pulverized, down by so much. And mission accomplished, I guess, from the Federal Reserve, because that's really what they want to do, is squeeze out this kind of rampant, immature speculation. And that's been really successful. And the overall financial structure of the nation and really the world is just fine. So if we have a few more months of this, it's possible, of course, that something would happen, some kind of cracks would happen in the structure, which Great Britain teetered with by proposing a very stupid budget. Is it possible we would follow those same footsteps? Obviously it is, but I just have to say it's not very likely.
Thanks, Val. Appreciate that.
Yeah,
We've had a number of questions put in the chat box. Is there an ideal balanced portfolio for the over 50 crowd that is not terribly risk averse? 60-40, 70-30?
Well, it's always difficult to just use age as the guideline, but based on what we've seen, and even with what's happened this year, basically this kind of 60-40 mix, or a 50-50 mix, perhaps for those truly risk averse, still seems to make sense. We haven't really had great rebalancing opportunities for most of this year, of course, because both have gone down. But this, what we've witnessed this year really is an anomaly. Let's all pray and hope that countries aren't invaded every year. That sends the commodity markets into a tailspin. That's caused half of the inflation that we've had to deal with. And of course, I know on 60 Minutes a month or two ago, it was declared that the pandemic is over. It doesn't matter anymore. It still matters. We're still paying for it. The measures that were taken to get us through it economically 2 years ago, last year, again, whatever one's opinion is about the wisdom of all of those, it doesn't matter. We spent the money, and the bills are coming due. This is the bill. We sent everybody out cash. We, did this, we did that, we did this, we did that. Now we're forgiving student loans. Those bills have to be paid, and that's because what all of those measures ended up doing was creating too much demand, too many people chasing too few things, and that just needs to be brought back into balance. So I know we're living through this tough year where the 40% in bonds or the 30% in bonds hasn't been much of a ballast to hedge against whatever is happening in the stock market. But again, once this is under control, which it will be, then that kind of 60-40 mix makes sense. And of course, you want to be really diversified within each of those components. Typical bond index fund doesn't have inflation protection in it. So that's something, that people want to be careful about, adding to the mix. And just also kind of recognizing sort of the trends of the world, and to make sure that people have their toes in the more vibrant areas of the economy, that even if they go down in the short run, makes sense certainly for the longer run. Again, things like biotech and alternative energy, things like that will be undoubtedly critical elements of the economy in 2025, even that early, and certainly way beyond that.
Thank you. All right. Who would you consider a reliable source to watch?
A television source. That's a tricky one. uh, I'll just speak for myself personally. I mean, I cannot stand CNBC. I can't watch it for 1 minute. I think Bloomberg does okay because they don't really talk about politics, and it's not all just cheerleading. Other than that, I mean, I think it's really difficult. I think really the key to what my key to absorbing investment information is to get a diversified set of sources, which I know is like exactly contrary to what you were saying. I think so you don't just want to read the Wall Street Journal because you're getting a very biased view of the world. You don't want to read the New York Times only because you're getting a very biased view of the world. I would say, I don't have any interest in the company, it's not a public company anyway, but The Economist does a pretty decent job of looking at things from a very high level, not really caring about individual companies, stock prices, things like that, and kind of paying attention to the longer term. So maybe if I had to pick one thing to follow, you could read the print edition of The Economist or look at the website, which is updated pretty reasonably. Diversification.
Excellent. Any comment on the hits that 529s have been taking, especially if there's closer in on getting, going into school or already in school, college?
Yeah, it's been tough because even with it, and this is why we have to always be careful about the conservative, aggressive kind of descriptions on some of them. And I mean, it's just very difficult when even the bond component of the investment goes down by 10% in a year. I know most of them, as it, right as tuition is about to be paid, normally don't stay even that heavy in bonds, but each 529 plan, unfortunately, has their own guidelines and differing definitions of what's aggressive, what the year when they call Plan 2023, that could be different between Vanguard and Fidelity. But yeah, I mean, hopefully the 529 wasn't, it wasn't it's such a tight fit that there's no other resources available. For the most part, people have some slack built in. But certainly, yeah, I mean, when all assets are down, the stocks and bonds are down, the 529 plans are down as well, even though as it gets closer to the distribution date, the variance does get tamped down a lot, but they can and have declined in value just because of what's happened.
Let's see. So as a general matter, I understand you're advising us to make no significant changes in our investment allocations and simply hope for the best, correct?
As long as the investment allocations are for the best now. I mean, I think we've been pretty careful about doing any kind of big rebalancing this year, because even though stocks have come down, but are they cheap? No. We'll know they are when everybody is panicking. Bonds have lost value. Are they cheap? No. Even if we just go by that core rate of inflation of 6%, and right now a typical bond fund yielding 3.5%. That's not cheap. And so it's, it's really difficult to say, oh, well, we should switch from something that's expensive and buy something that's cheap, because there's a real shortage around of things that are cheap. So that kind of mitigates against doing big changes. And the other reason I think that mitigates against big changes is because we don't, again, I have my prediction that inflation will settle down, and there's no reason to pile into long-term bonds or any kind of bonds. And there's no reason to bail out of stock. So that's, I guess as the data unfolds, I guess we'll wait and see. But right now, that seems a pretty reasonable prediction. And certainly, again, that this week shows that, oh my gosh, as soon as it looks like there's going to be some progress against inflation, things are going to take off. And it happens too fast. We can't anticipate it, because really nothing happened over the weekend to make things go up by so much. And that's just why we just have to, I know it's not exciting, but we just really have to stay the course and not make big swings, because when it turns around, when things start to shoot up, it's when you miss those couple of days, like this week, 1,500 points on the Dow, can't make it back. You can just never recover those missed opportunities. And really the safest plan, the world is always uncertain, but we're pretty much at peak uncertainty now. And actually the safest thing to do when faced with uncertainty is just to get very diversified, always look to enhance it, always trying to see, well, is there some risk we're not diversifying against? But just to maintain that posture and not get into an overly aggressive or defensive mode.
Great, thank you. That was it for the questions in the chat box. Does anybody have any other questions they'd like to ask? Well, thank you all very much for joining us tonight. Really appreciate it. And we will have a recording of this sent out in the next couple of days, and that'll get emailed out to you. And we look forward to talking to you all soon. Hope you have a good evening.